One of the best things about dividend investing is that it can be a pretty hands-off approach. By nature, this is a buy and hold strategy. That's the only way you can actually receive the dividend, but that doesn't necessarily mean you can just buy stocks and completely tune out and forget about them. If you own individual companies, then you need to stay in the loop on what's going on with them. And in this video, we're going to talk about 3 things you need to look out for that could spell trouble for the dividend stocks in your portfolio. If you see any of these things in the companies you own, it could indicate a declining or suffering business or could be a sign that a dividend cut is on the way. So these are definitely things you'll want to look out for, and I think you'll want to avoid investing in any company that has these 3 things. So here on the channel, we talk a lot about the payout ratio, which is the percentage of a company's earnings or its net income that it pays out in dividends to shareholders. And a high payout ratio is definitely something to look out for because it could indicate that the dividend is potentially at risk, but I want to focus on a similar yet slightly different metric, and that's the free cash flow payout ratio. This is probably going to be obvious to you, but the free cash flow payout ratio is the percentage of a company's free cash flow that it pays out in dividends. And this is an especially important metric to familiarize yourself with, seeing as the dividend is paid out from a company's free cash flow. Similar to the regular payout ratio, the lower the free cash flow payout ratio is, the greater the company's ability to continue paying and growing that dividend. And on the inverse of that, the higher the free cash flow payout ratio, the less breathing room the company has to pay the dividend. You also don't want to see too high a free cash flow payout ratio because you want the company to have some money left over to do other things besides just pay the dividend. They can also use that money to do other things like pay down debt, buy back shares, or reinvest back into the business, all of which are important. And there are a lot of companies out there with low free cash flow payout ratios. Typically, you'll see it more common in the more growthier dividend stocks, the ones with the high 5-year dividend growth rates. And here are a few examples of some of the ones I have in my portfolio. First and foremost, here we have Williams-Sonoma, who in 2023 paid $3.60 in dividends per share. And in that year, they generated $23.10 of free cash flow per share, which calculates out to a 15.58% free cash flow payout ratio, which is very low. Plenty of room to pay the dividend and continue spending money on other things. Another company I own with a low free cash flow payout ratio is Visa, who in 2023 paid $1.87 in dividends per share, while in that year they generated $9.62 in free cash flow per share, which comes out to a 19.44% free cash flow payout ratio. So once again, very low. And this third company here is Snap-on, who in 2023 paid out $6.72 in dividends per share, while generating $20.02 in free cash flow per share, which equates to a 33.57% free cash flow payout ratio, which is a bit higher than the other two, but still, about 33.6% is still a very low free cash flow payout ratio. As you can see, all of these companies have plenty of free cash flow left over after paying the dividend to do other things. I think they're budgeting their free cash flow very well, and that's exactly what you want to see. Now, on the inverse of that, here are a few examples of companies with free cash flow payout ratios on the higher end. The first company here is Cracker Barrel, who in 2023 paid out $5.20 in dividends per share. Well, in that year, they only generated $5.57 in free cash flow per share, which comes out to a 93.36% free cash flow payout ratio, considerably higher than the other 3 companies we saw. And Cracker Barrel actually did cut their dividend. A few weeks ago, actually, they announced an 80% dividend cut to free up more money to invest into their restaurants, which is definitely a sensible move. But anyway, guys, the second company here is Smith & Wesson, who in 2023 paid 40 cents in dividends per share. Well, in that year, this is actually kind of interesting, they had a minus $1.60 free cash flow per share, which comes out to a minus 25% free cash flow payout ratio. And this means that their free cash flow was negative for the year, and they still paid out a dividend. Now, they either did this by dipping into some of their cash reserves and using the cash on their balance sheet to pay that dividend, or they funded it by taking on debt, neither of which are sustainable over a long period of time. Anyway, moving on to the third company here, this is Fat Brands, who in 2023 paid 56 cents in dividends per share, while in that year generated negative $3.86 in free cash flow per share. So this comes out to a minus 14.5% free cash flow payout ratio. So as you can see, none of these companies are budgeting their free cash flow very well. And in fact, with those latter 2 companies there, if that trend continues and they don't generate positive free cash flow, then those dividends are probably not going to be sustainable. And at some point, they'll have to do like Cracker Barrel did and reduce the dividend. There might be a dividend cut for those. And actually, on the topic of budgeting, before we move over to danger sign number 2, I want to talk talk to you about one of my favorite budgeting platforms and the sponsor of today's video, Squad. As investors, we are constantly looking for more money to contribute to our portfolios, and the best way to do so and to see where all of your money is going is through budgeting. Everyone should be budgeting. The problem though is that most budgeting apps these days make you give up your bank login credentials in order to sync your transactions, and while this does make things convenient, giving up this information comes with some pretty serious risks. By providing your bank login credentials to these third-party apps, you're giving them access to some pretty sensitive financial data, including your account number, routing number, full name, address, and you even give them the ability to initiate transfers, which is kind of sketchy. But this isn't the case with Squad. Squad prioritizes your privacy and security and is unlike any other money tracking platform I've used in the sense that it allows you to automatically sync all your transactions without making you give up your bank login credentials. Instead, all you need to do is set up your spending and deposit alerts from your bank or credit card provider to the Squad Scan email address you receive upon signing up, and then from there, Squad instantly converts these alerts into categorized transactions in the app. All in all, guys, it took me maybe 2 minutes to get everything set up, and that includes uploading all of my old transactions, which you can download from your online banking app and send to your Squad email address. It's super easy. With Squad, there's no ads and there's no concerns over the safety of your data because you're not giving them any of your sensitive data, which is the best part. So overall, if you're looking for a better budgeting platform, I highly recommend you check out Squad, which you can actually do for free. Click the link in the description of the video or in the pinned comment to get a free 15-day trial. And if you like it, their Duo plan is only $11 per year, which is an absolute steal. Not only that, but you can also take 15% off of the already extremely generous subscription price by using code Ryne15 when you check out. I've personally really enjoyed using Squad, and I think you will too, so definitely check out that free 15-day trial in the description or in the pinned comment and join the Squad today. So imagine that a business is like a funnel with a filter on it. Revenue comes in from the top of the funnel, which is the widest portion, and as the funnel narrows, it filters out all of the costs and expenses, and then what flows out at the end is the net income. This is why they call revenue the top line, and this is also why it's the first line item when you go look at the income statement. Revenue is the lifeblood from which everything else flows, and if a company's revenue isn't growing, then the rest of the financial picture can suffer as a result. Going back to what we were talking about earlier, dividends are typically paid out of a company's free cash flow, which is directly tied to its revenue. If revenue declines, the company may generate less cash, which can put pressure on the company's ability to sustain its dividend payments. Not only that, but declining revenue can also limit a company's ability to reinvest back in its business, which could result in them losing market share to their competitors, especially if those competitors are able to reinvest in themselves to continue growing and innovating. Overall, declining revenue is a huge red flag for investors, and it could indicate fundamental issues within the company, such as declining demand for that particular business or even for the industry as a whole. It can also be indicative of poor management or an ineffective strategy. Either way, addressing these issues typically require huge investments and strategic shifts, which create more risk for the business and could divert resources away from the dividends. With that though, let's take a look at where this has happened and where it's had a detrimental impact on the dividend. The first company where we see this correlation here is with Intel, whose 5-year revenue growth rate is negative by 4.85%, and Intel cut their dividend back in 2023. Unfortunately, I was on the receiving end of that dividend cut, but fortunately, somehow I was able to still sell out of Intel for a slight profit. Anyway, the second company where we see this correlation is with VNO, Vornado Realty Trust, who has a negative 5-year revenue growth rate of 3.05%, and they've reduced the dividend nearly every year since 2019. And moving on, last but not least, this third company here is The Gap. And I really like The Gap, but The Gap has a negative 5-year revenue growth rate of almost 2%, and they did cut the dividend in 2020, although to their defense, it does look like they've started increasing it again since then. Overall, you want to invest in companies whose future looks more promising than the present, and continually declining sales is a pretty clear indicator that things are headed in the opposite direction. So as a general rule of thumb, if you're going to be investing in individual companies, at least make sure you're investing in companies who are consistently growing their sales. So guys, going back to our funnel example from earlier, a company's profit margins reflect the percentage of what comes out of the funnel in relation to what went into it. Or in other words, it's the percentage of revenue that remains as profit after all expenses are deducted. When a company's profit margins decline, it means that somewhere throughout the company's operations, their costs and expenses are eating into the revenue more than usual. If this trend continues, it can result in less available free cash flow for dividend payments, for debt reduction, for reinvesting back into the business, all those things, which as we've outlined earlier, can be problematic for the dividend as well as the company as a whole. Generally, you want to see stable margins over time with minimal fluctuation, unless it's fluctuating to the upside, which actually would be great. And some great examples of companies where this is the case include Zoetis, first and foremost, whose net income margin went from 12.2% in 2014 to 27.3% in the trailing 12 months. That's quite a big jump. Another company that's seen some nice margin expansion is Rollins, ticker symbol ROL, whose net income margin went from 9.8% in 2014 to 14.2% in the trailing 12 months. And then third and finally, we have Old Dominion Freight Line, ODFL, whose net income margin went from 9.6% in 2014 to a whopping 21.2% in the trailing 12 months. That's some nice expansion. And like I said, that's exactly what you want to see, as opposed to these next three companies whose margins have declined and whose dividend has also been cut. The first company here is B&G Foods, ticker symbol BGS, whose net income margin went from 4.8% in 2014 to a minus 5.4% in the trailing 12 months. And BGS actually cut their dividend in 2022. Next up, stock number 2 is VF Corporation, VFC, whose net income margin went from 11.2% in 2014 to a minus 9.3% in the trailing 12 months. And VFC actually cut their dividend twice last year. But anyway, this third company here is Walgreens Boots Alliance, WBA, whose net income margin went from 2.5% in 2014, so already starting out pretty low, but they went from that to a minus 4.2% in the trailing 12 months, and they cut their dividend earlier this year. So tying all of this together, guys, overall, a very simple rule of thumb to follow if you're gonna be investing in individual companies is to only invest in companies who, number one, are growing their sales, who are growing their revenue over time, and number two, just generally not losing profitability over time. I think these two things are very easy things that you can look for, and 3 great examples of those companies can be found in this next video right over here. These are all incredible companies, and admittedly they're not at any sort of crazy discount right now, but still they could potentially be worth the price, and at the very least they're ones that are worth keeping on your radar. So click right over here to learn more about those, and I'll see you in the next one.